say well priced. A lawyer, for me, it's difficult to say. I think the price is there. The main difference from say our experience is that banks had more time to provide for their loan book. So decisions are made this year, which will probably have an effect in particular for Germany next year, that either loans or assets will come to the market at the price they are, and at the same time not having the, let's say, adverse effect on balance sheets that they would have had 2 years ago as a result of the time to provide against them. So the pricing, say, is there where the market is. I would see more product being available. I still see across all the Ashurst, say, offices, a strong tendency of, say, if you put it politely, digesting, say, the existing loan book and repackage that, giving it back to the market, either by NPL or individual workouts.
Historically, German banks were very reluctant to really do a workout on their portfolio. So I don't believe this will change fundamentally in 2013, so that there might be something coming to the market. Yes, we have seen also some in the resi side, some transactions in Germany. The Balbecon portfolio was one of the issues we've seen this year. There might be one or other opportunity coming, but in general, I'm not imagining that we see a rush of opportunities coming out of this area, because the banks still have their problems on the other side, and a lot of them are not willing to take the write-downs on the balance sheet. That's my opinion on it.
For us, an interesting market is, and I agree that you don't find many deals from German banks, but you rather have to go to London. We find that the British banks or American banks are much more willing to write off and to offer interesting opportunities. And there we are looking and going to loan services in London and find interesting deals. Of course, in many instances we cannot transfer those properties directly into our funds, because they need a lot of asset management and redevelopment. But if you build a chain and bring in German developers that you know and combine them with those assets where a big write-off is possible, and then you make a deal with the developer beforehand, you bring him the asset and say, okay, this is what we want, and you need to extend the leases with the main food anchors and then bring them into our fund later at a discount because we initiated the deal. There's some attractive money to be made, and we've done the first 2 deals along that strategy in this year. So rather go to London and talk to the banks there, because they're further away, and once the property is at the servicer, of course, when you're dealing with the person who hasn't done the deal initially or hasn't financed the deal initially, then there's a greater willingness, of course, of giving up positions and write-downs.
And these, just to be clear, these are assets. These are assets in Germany, yeah, but they're being held by UK or US banks currently, who then simply want to have them off. Essentially, don't want to manage the asset. There's too much capex, or there's too much.
Or they are coming out of CMBS structures, and the ownership is not so well known.